In today's video, we go through the Reserve Bank of Australia's next move. Are they going up or down? You'll find out soon. And is it the best time to fix? We're going to cover that exactly. So guys, let's dive in. Showtime. All right, so let's start with the Reserve Bank's stance on the cash rate. With a lot of global pressures, obviously an evolving economy back here at home, and some changes out of the US, there's a hint that the Reserve Bank might not be as quick to start cutting the rates. Yeah, a lot of people were expecting rate cuts to happen probably mid this year, but recent data indicates that stubborn inflation in the States could actually mean there is a delayed and expected rate cuts here at home, and this might make some impacts to everyone, investors, from everyday home buyers, that we're expecting these rate cuts to come through. Now, Jayden, we've seen similar challenges. We've seen some banks making predictions. What are you sort of seeing out there? Yeah, so ANZ, one of the big banks here, they've actually pushed back the earlier predictions from mid-year, and even money markets have pushed things back to later in the 2024 calendar year. AMP's chief economist Shane Oliver, on the other hand, believes that we're pretty different from the US economy, and we could start seeing rate cuts as early as August or September 2024. He did disclaim that there are some challenges around inflation, and that could change Reserve Bank's view on moving those rate cuts forward. Yeah, interestingly, even looking at previous rate cycles, if we look at the last 6 or 7 times where we've seen rates peak, on average, it's taken 11 months from when the last rate hike happened to the first rate cut happening. So if we look at it 11 months on average, that actually brings us to around October time this year when we could start seeing rate cuts come through. A lot of economists are predicting late this year, maybe even early next year. So we'll definitely be interesting to see what happens and what really comes through of it. In view of this, we are starting to see people ask more about fixed rates and how that looks, but we're going to come back to that a little later in the video. Yeah, and an interesting twist, while we're starting to see a little bit of a concern about rate hikes or even rates not going down as quick as everyone's expecting, the real story might be the undercurrents around the property markets itself. We're starting to see, whilst rates are at historic highs, property prices might not actually be affected due to a significant crunch in new properties being constructed. Australia is currently experiencing an 11-year low in new housing construction, which means fewer homes are on the market when we've had a historical high migration, which has really caused a housing crunch. Guys, if you do find value in this video, please do us a little favor and hit that subscribe button, as it does help out the channel, and a big thank you to all our subscribers for your support. Inspires us to create more content we hope you enjoy.
And here's to you.
Yeah, so to your point, Nathan, the compounding issue we're seeing here is the migration rates, and I think this is going to become a bit of an election issue as we get into that cycle. More people are coming to Australia, but the construction sector just isn't keeping up. We're falling short by 90,000 homes from this year's target of over 200,000 new starts. This mismatch in supply is causing a huge shortage, and that's why we're seeing pressure in rent, we're seeing pressure in property values, and there's no real good news in the short term. At least with the local elections here, I'm hoping there's going to be some changes with some of the council planning. You know, a quick way to solve this could be potentially allowing granny flats to be put in more easily. That could easily help supply rather than having to start new greenfield developments. But hopefully the government's going to come out with this, potentially even change some of the visa regulations to put more boots in the construction industry here, just to alleviate some of these constraints and help supply more properties to put more homes out there. Yeah, particularly given we've seen so many construction firms go bust recently. We've seen in Victoria, they did make it very easy to get granny flats. I think they've removed all approval requirements. So if they started doing that in other areas, like here in Brisbane, where we've got a real shortage in housing, the rental market's through the roof, and they made it a little bit easier to build a granny flat. They're a lot cheaper, easier solution, and made it a bit more affordable for all to get in the market, I think is a great solution. Now, one of the biggest elephants in the room here is a lot of people are asking us, right now, is it the best time to fix it? Particularly given the new data that's come out, looking likely that the Reserve Bank might actually not make rate cuts as soon as everyone's anticipating. Jayden, what do you think about the timing of fixing, and what are you actually doing yourself personally? Yeah, the interesting thing is, like I mentioned earlier, with the money markets, they're still putting like a 50-50 chance on a rate cut this year. So then as a result, we're seeing some of those 1-year fixed rates at the same level, or even in some cases slightly higher than what the current variable rates are. So put in other words, you could potentially have a variable rate at say 6.3, 6.4%, and the 1-year fixed rate is at 6.5, 6.6%. So actually paying more for the certainty of fixed rate. So in a lot of cases, a lot of clients we're talking to today, they're saying, you know what, I'm just going to ride it out. I think it's probably going to stay the same, if not go down. There seems to be more downside, there seems to be more risk in fixing, because you could end up paying for an extra rate rise over the next year. So for a lot of people, they are thinking that. For investors though, it's a different story. I've seen a couple of investors sort of look at the 2 and 3 year fixed rates. They're currently at the same level and below. And for them, it's just about locking in their risk. They don't want to have extra rate rises there, and they're happy to take on that higher interest rate. Yeah, I think even for some owner occupiers, we've seen 2-year fixed rates with a 5 in front of it, somewhere in the high 5s. Your current variable rates are in the low 6s. So if you are looking for that stability, you're worried about where the market's going, you can afford those repayments, and you really want to lock something in for 2 years. Think of it like your rent. You know what your repayments are for the next couple of years. Well, maybe not fixing all of your loan in. You could go for half of your loan fixed, or a certain percentage. You can choose a denomination you like. Might give you that certainty you're looking for. Because look, the money markets have routinely got it wrong. We know with the Reserve Bank governor, Philip Lowe, who's no longer the Reserve Bank governor, way back when, what was it, 2000, he said rates would not move until 2020. Well, guess what? 2024, he wouldn't, they said they wouldn't move rates until 2024. And guess what? He started moving well ahead of that. We had a nearly 4% increase over an 18-month period of time. So even the money markets routinely get it wrong. I think you've got to make a decision based on your own individual circumstances, on what you think is right, not even what we think is right. At the moment, I personally feel that a variable for myself makes more sense, given that it feels like there's a high chance rates are going down. But for yourself, you might think the opposite. I could be wrong. So I think you've got to make the decision based on your own individual circumstances. Now, how long to fix for as well? Jayden, you can fix for 1, 2, 3, 4, 5 years. What do you think would be the best move at the moment? Again, it depends on your situation. If you're buying a unit as your first home, it's as a bit of a stepping stone. You might only live there for a year or 2 or 3, then you might upgrade, you could have a family, things can change there. So keep that into mind, because things can change quickly. You might have just started dating someone, you get married, have kids in a couple of short years, and fixing for 4 or 5 years could be an impediment, could limit your options in the future. So keep that in mind. That is definitely where a variable rate helps. You can make extra payments, you can use an offset, you can chunk it off a bit quicker. There's a bit more flexibility around that. And I think especially for an investor, fixing, you might go interest only. You know the rent you're getting, you know your repayments, your ongoing fees, and having a fixed rate might give you that stability with your cash flow. You know exactly what you're up for. You can put that amount of money away each month or week or fortnight, and you know exactly that that's your fixed repayment. You know what's coming up. For some of our owner occupiers recently, I've started to see they've really stuck with more variable, more so than fixed. But once again, it's not all, the same for everyone. Every circumstance is different. And that's where here at Hunter Galloway, we're a mortgage broker. We can have those discussions with you, give you those ideas, the things you need to think about, and make sure you're making the right decision both for now and the future, because there's no one size fits all approach.
Everybody's different.
Guys, remember to like, share, and subscribe to stay informed with all things property and finance here at Hunter Galloway. Jayden, what's your takeaway from today? Yeah, I think keep in mind that there's no guarantees of anything really, but it's looking not as likely, it's not a definite lay down misere that the Reserve Bank is going to be cutting rates later this year. So if you're relying on that, if you've got an existing mortgage, then potentially have a chat to a broker. Hit us up. We can potentially see if there's some lower options or some cheaper deals in the market. There has been some changes with some of the banks lately in how they'll assess a refinance. So if Nathan's going to buy a brand new home today, he's a first home buyer, the banks will apply a 3% interest rate buffer. So if you're paying 6.5% for your interest rate, they'll apply a 9.5% interest rate buffer when they're calculating. So it just means his affordability is terrible. Well, it's not as strong compared to with a refinance, the banks only apply a 1% buffer. Now, to put this in context, still a lot of numbers. I had a client the other day that had bought a home a couple of years ago during COVID, had gone up, had tried to refinance with a normal buffer, and the banks wouldn't lend him $1. We looked at some of the lenders that offer this simple refinance, the 1% buffer, and his capacity was over $600,000. It was insane the difference it makes. So if you've got a home loan, that you don't need to be a mortgage prisoner. We can check out options and see if there's something cheaper and something better, something that's going to help you with affordability if the rates don't go down. So make sure you hit us up at huntergalloway.com.au, home for home buyers across Australia. And I guess with higher rates, it's become harder to borrow money. Serviceability remains the #1 issue we're seeing for a lot of our clients that can't refinance or even buy an investment or a property of their choosing. And there are lenders still out there that can help you from refinancing if you can't afford it, like Jayden said, or even to get you a higher borrowing power. A lot of lenders have strict serviceability ratios that they need to apply, but we do have some lenders that look outside the box who can actually lend you more than the mainstream lenders. Yeah, these are typically non-bank lenders. They don't have the same regulations that the big banks have. There are risks with that. Potentially they have different sources of funding. So you need to be educated on both. That's where we can help. But at the end of the day, it can help you get into the market, help you build your investment portfolio. What we're seeing a lot at the moment is people go to these non-bank lenders for a short period, 1, 2, 3 years, then potentially refinance back to mainstream lenders once they've built up equity. They might add a granny flat, increase the rental, add some value there, or their income can increase. So it can be good. It can give you another option if you're not sure of it. Yeah, it's going to be interesting to see how things play out later this year. There's obviously the stage 3 tax cuts coming out too. This could even play into the RBA's cards, where if people take those extra tax cuts and save it in their bank, it's potentially going to help with inflation potential. If people go and spend it, it's going to cause issues. So there's a lot of factors at play here. But at the end of the day, you need to be comfortable in your situation. So if you've got an existing home loan, you want to review, we can help out with that. Or if you're trying to buy a home and the bank's not telling you the right numbers, isn't giving you the affordability you want, get a second opinion. And that's where we can help out at Hunter Galloway. Yeah, feel free to hit us up at huntergalloway.com.au or call us directly on 1300 088 065. Guys, as always, thanks for watching and we'll see you next time.